Well, good morning, everybody, and welcome to the next in a series of our quarterly macros. Very pleased you could join us. Obviously, we're doing these to give you an idea. We recently issued a macro report, and the idea of these is really to have Sanjay Joshi, who's the head of our fixed interest, and Roger Jones, who's head of our equity team, to talk about what's going on in the markets, to try and give you a feel for what we're seeing and where things are going. And really to open up the floor to you to ask questions. You've got an option to go onto the chat and post your question. I suggest you do it to the panelists, only because my internet is pretty poor. I keep dropping off, but we'll endeavour to then field your questions through to the panel and answer any questions you have. So on that note, what I'm going to do is I'm going to hand over to Sanjay to lead us off. And thank you very much for joining us.
Thank you, Kate, and good morning, everyone. Nice to talk to you all again. We, live, as we said last time, in extraordinary times. With who would have thought we would be in a position where we'd be working from home? Well, some of us working from home for months on end. Global disruption in terms of labor markets, travel and so forth. But it looks like we are emerging from that. And, from a macro perspective, what I want to do is just spend a few minutes mapping out where we think the risks are, where we think the opportunities are, but really focusing on really what the governments and central bankers are doing, because that is really critical, because we could spend enormous amounts of time discussing what shape economic recovery we're going to get. But we won't reach any sort of plausible conclusion. Clearly, from a macro perspective, as the IMF has said, we face exceptionally uncertain times. A lot depends on how the health crisis will be dealt with as we come into the winter months. But what we are seeing is the global economy is reopening. We are seeing that in the case of China, there's been a significant bounce back in almost every part of the economy, from manufacturing through to services, through to retail sales. We've seen a decent bounce back in employment growth in the United States, and most economic indicators are also suggesting a decent third quarter bounce back in GDP. Europe, of course, has dealt with the virus somewhat better than other regions, and we are seeing quite a strong recovery in Germany. So it would suggest there's a V-shaped recovery, but let's not sort of dwell on that too much. I think the key point here is that the economic recovery we're going to see is going to be quite shallow. It will require at least another 18 months before we return to end 19 global GDP levels. There will be a significant output gap which will be in place over the next 12 to 18 months. There will be significant deflationary risks as a direct result of that. And one of the key economic risks is really the labor market. The dislocation we've seen across the labor market in the developed economies has been one of the most severe we've seen since the 1920s. Now, even though we've seen 8 million jobs being created in the US, you must not forget that the unemployment rate is still some 10 percentage points higher than the full employment levels we were seeing prior to COVID-19. And I think that is really the key point, that how quickly can we, one, rehire people who are being laid off, two, prevent significant job losses going forward in many sectors, and thirdly, can we get back to the sort of wage levels we were at prior to COVID-19? All of these questions really are exercising governments and central bankers and remains a key underlying risk. A second underlying risk that we are focusing on, Roger and myself, when we analyze companies, is the CapEx plans going forward. What we saw over the last 2 to 3 months is a disruption in CapEx. It is unlikely that in many sectors, such as travel, such as airlines, such as pubs and so forth, restaurants, retail, we're going to see a significant increase in CapEx. The question is, will the big industrial companies, the big auto companies, the big energy companies resume capex as they were prior to COVID-19. That's a second risk we know that the governments and central bankers are monitoring. The third risk is the trade disruption that has taken place. Will world trade growth come back to the levels we had prior to COVID-19? So these are the sort of areas we're looking at. Now, having said all of that, we are also optimistic in the sense that we've seen a very significant response from policymakers. Monetary policy, as we said to you last time, will have a multi-layered approach, and it is really panning out exactly as we thought it would. Zero rates or negative interest rates, QE, corporate bond buying, the cash injection that's taken place for companies, consumers, and banks. All of that is good news. And all of these planks of monetary policy will be with us for a very long period. Now, what does very long mean? We think for the next 2 to 5 years, get used to central bankers being part of the capital markets, being part of the economic system. They are now moving from providing an economic bridge, which they did in March and April, to really being a constant part of what we will be seeing over the next few years. And there will be a further twist coming because we believe the yield curve control will become absolutely critical for central bankers as we see further loosening in fiscal policy. Yield curve control is basically, as with the Bank of Japan, we will see central bankers targeting certain levels of interest rates. In Japan, it was zero rates. We won't have that on yields, but we will have much lower bond yields going forward. Fiscal policy, I think to some extent, the UK and Europe is setting the stage for the second phase of fiscal policy loosening. First phase was again just an economic bridge. Second phase is, as in the UK, tax cuts, helicopter money. In the case of Europe, grants and loans amounting to 750 billion euros. And we would expect similar moves taking place across all the developed economies. In the case of the US, of course, there is a fiscal cliff coming, but it is almost likely that they're going to roll over the furloughing scheme and other the other fiscal programs that they have. So fiscal policy, again, will be loose for a long time. So yes, there are concerns about the economic outlook. It will be a prolonged recovery period. Monetary policy, fiscal policy will help. Even if the economy is stronger than our base case scenario, the IMF's base case scenario, it is unlikely that fiscal and monetary policy will shift away from where we are. We have to get used to low interest rates. We have to get used to higher government debt levels. So that's from the macro perspective. And I think when we come to fixed income, our overall stance has been pretty constant over the last few months. And really there's 2 or 3 key strands in this. First of all, our overall duration is somewhat higher than it would have been prior to COVID-19. So our institutional portfolio mandates and most of our other private client mandates would have had duration of 3 to 4 years. That shifted up to around 5 to 7 years now, depending on the sort of mandates we are running. Secondly, our exposure to higher grade corporate bonds is significantly higher. We believe, given the uncertain environment, it is better to have these high quality bonds taking a greater exposure within portfolios because, and I'm sure Roger will talk about this, the uncertainty and the volatility in risk markets could yet lead to further flights to quality. Having said that, even without a flight to quality, high-grade corporate bonds provide significant value given the credit spreads we are seeing. Now, the third layer is really based on how governments and consumers are going to reconstruct the global economy from ground zero. I'm always sort of seeing March, April as a ground zero for the global economy. And so what is it that both governments and consumers want? And you will see on this slide in front of you, I think it's absolutely certain that banks will play a vital role. They are a source of strength, not a source of weakness, as in 2008. Both consumers and governments want them. So that remains a key exposure for us. The big electricity companies, water companies, these are all going to be absolutely critical. We all need these sort of basic needs, and they form a very important part of our exposure. Pharmaceuticals, tech, telecom, consumer staples, these are all areas that are critical from the government's perspective and critical from the consumer's perspective. So that is how we are positioned in terms of fixed income markets, higher duration, higher our high grade exposure and focusing on these sectors. And I think this probably provides a good sort of follow through into Roger, who will talk about the equity markets, and then we can have a broader discussion on financial. So over to you, Roger.
Yeah, thank you very much, Sanjay. Yeah, I'd agree that with what Sanjay said there in terms of the difference in what we've seen across asset markets has been quite extreme, especially when we look at the recovery seen in equity markets. We had, just to put it in context, the largest sell-off in history, in stock market history, in terms of its speed and magnitude in February and March, followed by the sharpest recovery we've ever seen as well in April, May through June, and continuing into July. So we've seen this huge sort of disconnect almost in terms of equity markets. And this disconnect comes around quite simply from the point of view that index levels have recovered strongly and are nearly back up to where they were. However, we've seen earnings still continue to struggle, and we see this in the top right chart on page 5, where the blue line represents the Europeans' earnings per share for the MSCI Europe, and the orange line represents the MSCI Europe index line. So we see a big collapse in terms of earnings, but obviously index levels have just about returned. Now that can't go on indefinitely. We've got to either have a strong recovery in earnings, so this speaks to the shape of the recovery, and the issue we've had with this to some extent is there's a lot priced into equity markets, and these high valuations, they're considerably higher when they have been when we look against a historic average, now almost 2 standard deviations above in terms of the price to earnings ratio. That actually speaks to probably lower returns for equity markets. And we look at this in terms of the recovery against corporate bond markets, where we've got significant support schemes in corporate bonds. We've got central banks buying corporate bonds, but these actually haven't recovered to the extent of equity markets. So the challenge for equity markets going forward is that the amount of stimulus and liquidity that might well have made its way into equity markets has made valuations challenging, which probably speaks to challenging future returns. So we're taking a fairly cautious view in terms of equity investing. We feel it's important to have a quality bias, companies that have strong balance sheets, because strong balance sheets give corporates options over the next few years to look to take market share when others are struggling, to look to acquire businesses that have fallen to attractive levels, or alternatively, if they don't see growth opportunities, return cash to shareholders, which clearly in this low income world, it will look very attractive when that proposition it does come to the fore. So I think in terms of equities, we acknowledge this challenging fundamental outlook, but there's still this big momentum from liquidity and price that could continue to drive things higher. So we still want to have a position and allocation towards equities, given that given this momentum, but into this should be fairly moderate in terms of equities. In fact, our general asset allocation has the lowest allocation to equities that we've had over the last 10 years, because the risk reward for us just does not look attractive enough at this point of time. Now, that's not to say there are no attractions in equity markets. Clearly, healthcare is an area we think still looks attractive. A lot of the political drug pricing risks have most likely been removed from as an overhang for the sector, and also the importance of healthcare has come very much to the fore over the last few months, and the ongoing restocking that we'll see in terms of healthcare and the need to have good healthcare in place for societies is going to be an attractive place to be, given the good visibility, given the strong cash flows. And also we actually see healthcare stocks are still trading at a discount to market valuations, which looks a little bit anomalous for us. Also, we're aware that things could change very quickly. There could well be a change in sentiment. There could well be disappointments going forward in equity markets. And this could move to more aggressive price action again that we've seen. And we will look then opportunistically at increasing equities, picking up good quality equities at lower levels. But for now, we think it's very much patience first. So with that, I'll hand over to Kate to moderate for questions. Thank you.
Thanks very much, both. So there's a couple of questions that I've got. And one of them is, obviously central banks are supporting the markets at the moment, buying corporate bonds, buying into the market. You know, when do we see this running out? Because it seems to be covering up a lot of underlying issues and supporting things as it stands. But at what point do we think, you know, governments can't continue to support forever? So do we see this in the next sort of 6 to 12 months, or is this a longer term issue?
Let me kick off with that. I think generally what I would say is that the central bank purchases are twofold. Firstly, government bond purchases, and these are unlimited, and these will be for as long as is necessary. We would expect these to be maintained, in the case of the US, well through into the end of 2021. In the case of the ECB, we're talking about the next 2 to 3 years, and the Bank of England similarly. I think there has been a misconception or a misperception on the corporate bond purchases, because frankly, the Fed has bought only about the last count is about $20 to $30 billion of corporate bonds. The real buying has come from investors. What the Fed did was it crushed bond volatility. The MOVE index, which is the key area that the markets look at, and that had an impact on equities, as Roger will talk about in terms of volatility, I'm sure. But as the Fed crushed the MOVE index, crushed government bond volatility, it really reopened the corporate bond market, and that has led to the significant involvement of investors rather than central bankers. So I think the corporate bond purchases is more a reflection of the fact that the companies have done 2 or 3 things. One, they clearly issued at record levels March, April, May, June, but they were doing that for specific purposes. They were increasing cash balances, hoarding cash. Secondly, they were taking advantage of very low interest rates. And thirdly, they were extending outstanding maturity of bonds by retiring short-term debt and issuing long-term. I was doing some analysis on Coke today, Coca-Cola. They had numbers out the other day. They were much lower than expected, but in the background, they issued almost $11 billion of bonds in March and April. They issued bonds out to 2060 maturity. The leverage is still only 3 times, but the cash on hand is up to $20 billion. Now, that is a perfect recipe for a corporate to allow them to function during this period. So I think the corporate bond purchases from central bankers will always remain in the background. But the key thing here is, as we have seen, is the inflow of institutional money into the corporate bond market has been huge. And there are other factors such as demographics and so forth also playing, but I think it is a very, very important part. But I think, Roger, clearly the central bank interventions also had an impact on the way the equity market has behaved generally.
Yeah, absolutely. Clearly, it's boosted risk assets significantly. And I think, as you mentioned, just in terms of the central bank being willing to buy corporate bonds, although the Federal Reserve bought very few corporate bonds in the end, has shown it's kind of been an underpin in the market. And that's really gone all the way through to equity markets as well, and pushed them up. And clearly, I think investors were caught in very low positioning towards equities in April, and the bounce back has been very strong. In terms of how long it can go on, well, I think the model clearly here is Japan, which has been going on for a very long time in terms of quantitative easing, in terms of debt issuance. So this is not a medium-term issue. I think we've got to look the other side, and along with the Japanese experience, is we should expect very low levels of growth. So much more of an issue for equity markets, low growth, than bond markets with where financeability and ability to repay debt still looks pretty good. But I think we've got to be cognizant of all these actions that the central banks are taking, and the stimulus and liquidity becomes less effective as time goes on for risk markets, and also leads to a fairly depressed longer-term growth environment.
I suppose, Kate, before you come in, I was just going to ask Roger, it's quite interesting. You mentioned the Bank of Japan, because the Bank of Japan, of course, also bought equity ETFs. At the moment, we're not seeing any indication from either the Fed, the ECB, or the Bank of England that they're willing to countenance that sort of movement. But I suppose, you know, given the outlook, given the COVID threat, we can't discount it going forward, I'd have thought.
No, I think that's right. You can't discount it. I think you probably need much lower equity levels for that to happen. But yeah, I think they will certainly use every measure. It's becoming increasingly clear that central banks will use every measure available to them to be supportive during this period. And if markets do have a significant wobble again, this could well be something that they look at. And you know, I think maybe it would be the ECB would probably, in my view, look at it first, because given that they probably exhausted more of the options than the Federal Reserve.
Thank you. Another question is, and we've talked about this before, the high yield market. Obviously, there was concern around high yield and increased levels of default, but we've seen the high yield market rebound quite significantly in Q2. You know, what is the outlook for that? Are we seeing the defaults coming through, or is it more anticipation but not actually happening yet?
But defaults are happening, but I think let's do with the high yield market, because we had such a strong bounce back in the corporate bond market generally and risk markets. The correlation for corporate high yield with this particular sort of bounce in risk markets is very, very high. So they have rebounded on the back of that. And of course, also the fact that companies have been able to access liquidity through the corporate bond market and through central banks has helped a great deal. But I think you need to be careful we need to be careful in terms of judging what's going on in the high yield market, because there's a clear differentiation between BB plus and down to CCC. The BB markets, which includes, by the way, now companies like Ford, GM, and GE, are the areas that have benefited the most because they have received central bank assistance, but also investors are focused on that. Once you get away from these very large corporations, it's a very different marketplace. Also, don't forget, in high yield, you have CoCo debt, AT1 debt, which has rebounded strongly in the second quarter, and also the companies that we were looking at earlier, utilities, the corporate hybrids all sit in the high yield sector. So, you know, the SECs, the EDPs, the EDFs, RWs of the world, they've also rebounded very, very strongly. So when you look at, that's the reasons why we've seen the corporate high yield bond market doing very well. As it comes to default, and I'm sure Roger will comment on this as well, because this is slightly different from high yield and high grade, which is that there are large parts of the global economic infrastructure that may not reappear as they used to pre-COVID-19. And I'll just mention a couple, and then I'm sure Roger will take up the slack on this, is travel, retail. I won't mention any names, but Roger can go into a lot more detail on that. The hospitality sector, the airline sector. And I think that is where I think, Roger, we're already seeing significant moves taking place in the corporate landscape, are we not?
Yeah, absolutely. I think I add real estate and commercial properties into that as well. There's clearly, in terms of the lasting impacts of COVID, which I think are probably, from an investment point of view, the ones we really need to focus on at this point, a lot of industries and the shape of a lot of industries will change. There's been some step changes in terms of technological advancements and consumers' willingness to use tech out of necessity rather than just out of adoption. So I think we've seen quite a lot of this going on, and it has created a very different landscape. And some of these businesses were structurally challenged going into COVID. And COVID has really, I think, finished a lot of these businesses off. And you know, I think the good news from this, what we've seen is a lot of these businesses are not becoming zombie companies and taking up a lot of the very low cost of debt. These businesses are being significantly shrunk. We're seeing a lot of clearly restaurants, retail, high street retail, mall operators reducing their store numbers. So I think this is something that was structurally happening anyway, but has been accelerated significantly. The big questions that will still lie out there is the requirements for office space, clearly, going forward, a lot more working from home, remote working, and also in city centre apartments, all these sort of areas. I think there's still some question marks really over how these markets will evolve in a post-COVID world. Will the world go back to where it was before, or will there be lasting changes?
And of course, part and parcel of this, there are some companies, because of the changing business requirements, just thinking of two, we have TM Lewin disappearing in the UK High Street, and Brooks Brothers, I think it's been around for almost 150 years in the US, which is very long for the US in terms of history. They're also disappearing. We're seeing Chapter 11 for a number of, and I think the key point here is, as Roger makes, is that if the companies were weak prior to COVID-19 is just going to make it impossible for these companies to operate. But I think the other thing we should mention is that we are also focusing very heavily on key sectors that are very heavy employers, airline industry, hospitality industry, auto industry. Clearly parts of it may well restructure towards hybrids and electric cars, but then it's the big companies like VW who are better positioned to deal with that, Ford and GM, rather than smaller automakers. So I think, these are very, very profound changes that will take place in the way that we all operate going forward. And in the energy side, utilities, again, what we're seeing is this renewable energy infrastructure investment is going to be significant. And we did mention on fiscal policy, infrastructure investment is going to be absolutely critical. Now in the UK, we're not very good at infrastructure investment, so we may well announce a lot. Whether we deliver is something very, very different on that.
Thank you. Another question, actually, it's one of the points we raised as well, was liquidity. Back in March, when the crisis hit, one of the things we struggled with was liquidity in the markets. Is this something insurers need to be aware of? Do we see this happening again? Obviously, liquidity is quite important.
It's interesting, liquidity. I think this is probably more relevant to the fixed income area than equity area, because it's exchange rate driven. Fixed income is still an OTC market, and there's multiple layers to this. The greatest liquidity is certainly in the US dollar market. We've had $1.3 trillion of new corporate bond issuance, large benchmark issues, and we've had from AAA down to a BB issuance in the US corporate bond market, and that remains highly liquid. Having said that, I think we participate both in the primary and the secondary markets. The best liquidity is in the primary markets, secondary markets. The liquidity is poor purely because the large investors are taking big chunks and holding on to them. They don't want to really trade in and out of them. So that clearly, is just a factor that we have to bear in mind, that there is going to be that sort of development. Europe is very similar to the US. Now, Europe, the UK bit of it is very different. UK has not had, so Europe has had about 1.5 trillion euros worth of bond issuance since March. The US 1.3 trillion, UK almost nothing. We've had about just a few billion of issuance, and there's two reasons for that, Kate, I suppose. One is the Brexit overhang. Do companies really want to issue in sterling and increase manufacturing capacity or service capacity? The answer seems to be no. And secondly, the currency swap doesn't work. So the biggest illiquidity is in the UK corporate bond market, because the Bank of England is buying bonds. There isn't that much secondary market floating bonds out there, and the primary issuance is almost absent. All the issuance is in the gilt market and very, very high grade KFWs, the IBs of the world. So the liquidity overall is clearly very, very good, but you have to really know. And we deal with 8 to 9 major investment banks. So from our perspective, we always tend to get what we want, but we like to trade through big blocks rather than doing small blocks. So that's really the fixed income. I think on the equities, people were talking about a disruption, but that didn't last very long at all, did it, Roger?
No, for equities, as you rightly mentioned, exchange driven, and our equity strategies are all predominantly large cap. So there was really no liquidity impacts. There was clearly and still ongoing very big daily price movements, and we're still seeing single stock and sector volatility being quite high, although overall VIX volatility has come down a bit. So prices still are, we're seeing quite large moves, and we're clearly seeing, I think, an impact from some of the options markets, especially from the retail options market. And I'm sure a lot of you have seen the Robinhood sort of press from the US in terms of some of the exuberance there in terms of the US markets and retail investors. So this has had an impact in some of the price movements, but in terms of volumes, obviously that is helpful, and we continue to see equity markets functioning pretty sensibly in terms of the trading disciplines and the buying and selling.
Thank you. I've got 2 more questions actually, and one of them is on negative yields. We have a couple of clients who are struggling in European markets, obviously, to invest and cover cost. The basic of even covering costs when you're looking at some of the yields we're getting in the European market. Sanjay, what are some of the things we're looking at, or how can you get around this, or is this something we've just got to live with now?
Fundamentally, we have to live with it, because we're going to see more and more movement towards zero rates and negative yields across the globe. Even in the case of the US, 0.6 may well come down to 0.2 or 0.3. That's something that we have to live with. But clearly, we use a number of strategies to try and improve the running yields we get for portfolios. So in terms of the sovereign exposure, we have gone slightly longer duration because we know that governments will remain in play for a long time. And I think that is a good strategy to undertake. Now, clearly it doesn't work for bonds because yields are negative across the board, but elsewhere you can do that. So if you're looking from a European context, I think it makes absolute sense now to reduce your exposure in the hardcore European markets, Euro markets, and increase exposure and pick up extra yield through BTPs, Spain, Ireland, Portugal, and so forth. I wouldn't say you'd have too much more in Greece and Cyprus, but certainly small exposure in Greece and Cyprus. I know and you can correct me, Kate, I think the exposure, the risk quotient is still 0 for all sovereign bonds. So I think, but then we just have to think about the credit aspects of that. The other thing is to look at it really are supranationals, where you can still get a pickup over government bonds. So the EIBs, Council of Europe's, KfWs, Landesbanks, and so forth is also very, very helpful. Covered bonds certainly helps. But then the other strategy we are using is for our dollar portfolios is to be able to buy European markets, and by hedging you pick up the extra yield, because dollar yields are still above European yields. That 50, 60, 70 basis point hedging pickup enhances our European yield environment. And finally, I think is to take a little bit more exposure into the higher grade and, dare I say, BBB corporate bond market. But I think we have to live with negative yields for some time. And I would also add on that one must focus increasingly on total returns that one gets on portfolios rather than just pure yields. So it probably requires a slightly more active approach towards managing portfolios. Some of our portfolios, even in euros over the last 3 months, are probably up over 1.5–2%. and that gives us an opportunity to maintain pretty good returns over and above the sovereign yields. But it is an issue. It will continue to be in place for some time. One thing that we discuss a lot on the investment team is with inflation low as well, we must always compare it to what it would be in deposits. You're going to get massively negative deposit rates coming through. So investing in assets is very important, but also, I mean, Roger may well comment on this. I know it's fixed income, but I think we must start looking at other asset types as well. So the very high quality, high cap equities that still provide dividends is something really one should also look at. I think, Roger, you would agree with that sort of.
Yeah, so as we stand at the moment, the US market, you get slightly less than 2% in terms of dividend yield. Europe, you get slightly more than 3% in terms of the European markets, and the UK is 5%. But obviously, we know that a lot of the UK just are postponed for this year, so that figure will come down. But in terms of the dividend side of it, we're clearly seeing an ongoing stream of dividends there. There's a difference in terms of the approach. The stocks we like have dividends that are growing and sustainably growing. But if you look at some of the companies that we invest in that pay reasonable dividends, some of the consumer staple stocks, you're still getting 3% dividend yields. And this is companies like Unilever, Procter & Gamble, so clearly very well covered, safe dividends. These are still growing each year in the region of 6%. So that's quite an attractive proposition. So I've heard these companies, I think very unfairly, in my view, referred to before as bond proxies. I believe these are defensive businesses, but they do. You can pick up some reasonable dividend yields and safe dividend yields. I would be cautious about using high dividend yields, because that is really quite a lot of risk implied in that dividend yield.
I was just going to say, Roger, it was very interesting, and we were analysing SEC, the big UK utility, came out with its numbers, and they were at pains to say that we are going to maintain our high dividend because it is absolutely crucial to the pension industry and insurance industry. So that just gives you a flavor. And I was just going to add, what we've seen in the banking industry, and I think this may well be important for the insurance industry as well, is the banking regulators have been very proactive throughout this crisis period, where they have worked with the banking industry to ensure that they remain strong. They have the forbearance that has been given on consumer loans has been significant. They have loosened up on some other regulatory requirements. And the reason I mention that is, given that we may have a prolonged period, I know because I used to work at Chief Economist at Daiwa, what it's meant for the Japanese insurance industry is that when you have zero negative rates for a prolonged period, you have to change something. So I think it's very important for the insurance industry to actually engage with insurance regulators to talk a lot more about what does it mean to when you buy Unilever or a utility equity into the portfolio? Should you have the same capital charges that you have historically? Because having negative rates has an impact both on your liabilities and your asset returns. So I think the insurance industry has to work a lot more with the regulators. And if they're like the banking regulators, they may well find that on the margin things can change proactively.
Thank you. I've got one more question, and this one's probably Roger. I know we've been doing it for some clients already, and other clients are looking at it at the moment, but hedging risk. There's a lot of volatility still out there in the equity markets, and obviously from an insurance perspective, volatility is costly. Capital is impacted by it. Is this something we would still be looking to do, hedging equity risk or risk in general on the portfolios, or is it something that actually now's not the time?
Yeah, it's certainly an option open to us, and we have been looking at this for clients. There's obviously a wide range of strategies we can do if we feel that markets have run a bit too far. The easiest part is just trim exposure to equities and bring that back a bit. But if it is more tactical in nature, then clearly we can use the futures market or the options market to hedge equity exposure and equity risk on a short-term tactical basis, or even a medium-term tactical basis. Now, there's pros and cons of using futures and options. Clearly, futures much more opportunity cost in terms of the hedging. You have a delta of 1 effectively, so a move in the once you clearly delta adjusted it for the underlying equity holdings, so you should get a pretty consistent move in the hedge. So if markets move down and your equity holdings move down, they should move much in line in the opposite direction. In terms of options markets, you touched on volatility. That's a crucial part, clearly, as many of you will know and understand, in terms of the pricing of options. That has started to come down a bit in equity markets over the last really 3 to 4 weeks. So it's become a little bit less costly to hedge. Prior to COVID situation, you had quite a big skew in terms of it was quite expensive to buy puts, well, it was quite cheap to buy calls. That normalized a little bit more over the COVID period, actually, and call options started to price a bit higher. So that gives you quite a good ability in terms of option strategies for using either put spreads or selling a call option to buy a put option. And so there's lots of areas we can certainly accommodate and look at hedging propositions for short-term tactical reductions of equity risk.
Thank you. That's all the questions I have. So on that note, unless any of the other panelists have one, I will thank you both very much for your time today, and thank all people for joining us. And we will send the slides around and a link to a recording of this video if anyone wants to watch it again. But thank you all very much for coming. Bye-bye.
Thank you, everyone.